Now what happens is moving is little more, one more step ahead. Now this equity is supposing one of the companies where you have invested makes a loss, then will all my assets go, will all my property go, that would be the question. But the liability is limited to the extent of your investment. The liability is limited to the extent of your investment. For example, let us take you had a factory and you had a borrowing of 50 lakhs and you had an investment of 10 lakhs. The earlier example, 10 lakhs you invested, borrowed from a bank of 50 lakhs and then you created what is called as a factory and a building, etc. Business runs under a huge loss out there. After selling off, then you decide to close down the business, you sell the factory, you sell what is called as a building, and then which was worth about 50 plus 10, 60 lakhs, you are able to generate only 30 lakhs from that. You are able to generate only 30 lakhs from that. Then what happens? What you owe to the bank is 50 lakhs plus interest, you pay 30 lakhs and banks basically has to take the rest of the hit out there. As an equity holder, you get blob, you do not get anything, because in that case your liability is limited. As an equity investor, in a partnership is different, sole proprietor is different. In an equity, am I right, Pratik? Yeah, in a equity your liability is limited to the extent of your investment. Supposing you had invested in Kingfisher Airlines, you had bought the shares at 14 rupees or whatever, 10 rupees or etc., whatever money, no banker is chasing you, your loss is okay, that is what is called as delisted, and you just wash your hands off, you just go back on a Saturday evening and enjoy somewhere and then forget about that what do you call it as sorrow and then live with it, that is all. Your liability is limited to the extent of your investment, over. That is where you do what is called as your credit analysis, right. Now I come to the third concept. First concept we talked about accrual, second we talked about entity, now the third concept. All this will be there in the first and second chapter of the textbook what is given to you also. If you want, you can also read through that and then brush it up. Now third concept, accountants are always mean, right, including me. Now mean, when I say we always follow what is called as being very conservative, they call it as conservatism concept. We will always record depreciation but not appreciation. There is always what is called as depreciation, because accountants are the most hated fellows in all your companies, you would know, because they will never pass your bill, right. So all of you know that, and liabilities is basically your liability is limited to the investment what you have made, that is all. As an equity investment I make, that is all, whereas in a partnership, in a sole proprietorship, the rule of the game changes, so do not worry about it. Now I talk about conservative concept. When we say being accountants are conservative, accountants will always enter the value the particular asset or investment at either the value they have purchased or the current market value, whichever is lower, because what happens? There is depreciation. Let me tell you what is depreciation. There is an AS accounting standard out there in your book and in your manual also, we can read through it, we will revisit it also sometime later. When I talk about depreciation, what is depreciation? Depreciation is the reduction in the value of an asset due to usage and passage of time, both, please understand that, it is usage and passage of time. Now can land have depreciation? No. Can, maybe in a very rare case, but usually what is there? There is appreciation. Do you ever record it? No, you will never record it, because what happens? We will record whichever is lower, the value at which you have purchased or the value at which you have bought, value at which you have purchased or the current market value, whichever is lower. This is also known as historical cost concept. Depreciation, let us take a little more elaborate example out there. I buy a building for about 10 lakhs and I say the building will sustain for the next 10 years without any major modifications or repair other than the regular maintenance. At the end of 10 years I may have to pull it down and then rebuild it again. So what I say, I use a straight line method. I say every year the value of the building is going to depreciate by 1 lakh. I use a simple straight line method. So the value of the building first year is 10 lakhs, when I do the second year balance sheet it is 9 lakhs, third year balance sheet it is 8 lakhs, and so on and so forth out there. That 1 lakh reduction that is there, what do you do with that? Tax benefit. Now how do you get tax benefit? That is a beautiful term. Basically that is not a loss, that is an extent of utilization that is there, that has happened during the particular period. Let me forget about building, let me take a machinery. Imagine I buy a machinery which can manufacture 1 lakh pieces of a particular component which that supposed machinery is about to manufacture in its life. At the end of 1 lakh I have to junk it and there is no value. Bought it for 10 lakhs or bought it for 1 lakh. I bought the machinery for 1 lakh, it can manufacture 1 lakh components. First year I make 10,000 components out of it. That means to what extent have I utilized the machine? To the extent of 10,000. No, is it an expenditure pertaining to this particular year? No, why? I paid the purchase, but who owns the machine? Have utilized the entire benefit of the machine? To what extent have I utilized the benefit? I utilize the benefit only to the X%. So, when we talk about P&L accrual concept, what has accrued for the year? Only 10% benefit from that machine has accrued for that year, yes or no? The remaining 90% benefit is yet to accrue. Is yet to accrue for me. So, that 90% value I have not derived. Tomorrow at the end of 1 year I might sell the business or I might close down the business. I can sell the machine, right? I can sell the machine and somebody can pay me 90,000 on it, yes or no? So, I have paid 1 lakh. What have I created? I have not created an expenditure. I have created what is called as an asset out there when I bought the machine. Now, P&L please do not mistake with cash inflow and cash outflow. You are mistaking it with cash inflow and outflow, not cash inflow and outflow. The expenditure that has accrued. I utilized, manufactured 10,000 pieces in the first year. To what extent have I utilized the machine? 10%. When I utilize 10%, what is the expenditure pertaining to that year of that machine? Only 10%. That is what I will write it as depreciation of the machine, rupees 10,000. Am I with you on this? At the end of that year, what is the value of the asset? Value of the asset in my asset side of the balance sheet is 90,000 still. Second year, I manufactured 15,000 pieces. Then in the second year, what is the depreciation? 15,000 is the depreciation, value of the machine in the balance sheet at the end of the second year is 75,000. Am I with you on this? Do not mix with cash inflow and outflow, keep that aside, do not mix with that. What is the expenditure that has accrued in that particular year? That is all what we worry about. Agreed? So, when we talk about, when you write that as an expenditure, what happens to your profit? Huh? So, what happens to your tax liability? Because he is so interested in tax, I have to bring that. What happens to your tax liability? Comes down. Now, imagine you have a piece of land, the land is appreciated, 1 second ma'am. Imagine you have a piece of land is appreciated 10 times, then you record it as an appreciation, that is, though what is called, there is no cash outflow, but income has accrued, right? So, you record it as an income, then what happens to your profit, madam? It increases, then what happens to your tax liability? Increase. I may not have any money, but I may have to end up paying more and more tax. Please understand that. Imagine I am not running any business, I am just sitting at home. I have an asset which I have inherited, a piece of land which is worth about 10 lakhs, valued at 10 lakhs, which my forefathers would have bought it. Today the value might be at 10 crores. If I write appreciation 10 lakhs, 10 crores minus 10 lakhs, that means that is an income which has accrued but not received in hand. Then my tax liability, where will I go? Even if I sell myself, I can't pay the tax on that. Right? So, accountants are always conservative, first and foremost. We will always follow what is called as conservatism principle, in the sense that we will record which is lower, purchase price or the market value, whichever is lower. As said earlier, that what we call it as historical cost, this again I would like to repeat, this is also called as historical cost. Supposing I bought raw material, or supposing forget about raw material, you made an investment in equity. You made an investment in IDFC Bank shares out there, because that is in the news. You know why it is in the news? No, not IDFC Bank, then I will have a heart attack, sir. IDFC Bank is in the news because it is getting it is merging, right, with Capital First. I don't know, there is a lot of news. Anyway, equity part of it, let us take it in a different session out there. Now, IDFC Bank is selling at 43 rupees as of today. You buy the shares, or you buy about 1000 shares of that. 1000 into 43 is what you have paid, and you show it as an asset, because you own the shares. You show it as an asset, as an investment in your asset side of the balance sheet. On the day I prepared the balance sheet, the prices dropped to 36. If the prices drop to 36, what will I show my investment as? I will show my investment as 1000 into 36, whatever is the value there in the asset side. the difference between the purchase price what I have bought 43 and 36, that is about 4 plus 3 7 rupees per share, 7 into 1000 7,000 rupees, I will show it as a loss in my P&L statement. With you on this? So far so clear? So we record, accountants always record whichever is lower. I repeat again, whatever I said now is also known as historical cost. That is where L1, L2, all your codes and everything will, you will be familiar with all that. Yes ma'am, your question. 11th year the machine is not there, I utilize, there is no, it is a scrap. If there is a scrap value, I get a scrap value. If I assume there is no scrap value, that is all. It is junk, I just have to throw it out. It will, it will not come as an appreciation, no appreciation. No, appreciation is only in the class, not in the books. Right, not in the books. In the books we will always talk about revaluation, that is a very different thing as together, we will look at it a little later. If you utilize it, that is the life of the machine has extended, that is all. Supposing at the end of the 8th year, I spend another 20,000 rupees to extend the life of the machine by 3 more years. Then what happens? That 20,000 rupees, I will depreciate it over the next 3 years, that is all. At the end of 8 years, whatever is the value, suppose the value of the machine is 10,000, I spend another 20,000 to extend it by another 3 more years. So value of the machine is 10 plus 3, 30,000. Life of the machine from that day is 5 years, that 30,000 will be depreciated over the next 5 years out there.
If I have underutilized the machine,
if
by the end of the 10th year, if I have underutilized the machine, I have not completely utilized for the 1 lakh parts it produced.
No, here in this particular case I did not take time, I took utilization, because that is why I said first year 10,000, second year I produced 15,000, depreciation is 15,000, here I based it on the utilization. Normally, as per accounting rules, your depreciation is normally, there is a guideline which is basically given out there. For a car, supposing it is a computer depreciated in 2 years or 3 years, I do not remember the guidelines because I am not a well versed with that. Or supposing it is a car, 5 years, 3 to 5 years, Pratik? 60? Computer 60%, chartered accountants know that better. Now, if it is a car, 3 to 5 years, right? 20% per year. So that is, there is a guideline given by what is called as your tax laws, you just follow the guideline and depreciate. We might say the car might be worth, it is usable even in the 6th year, fine, use it, there is no depreciation, that is all, it is a completely depreciated asset out there. So what happens? There is no cost that is getting added as an expenditure, simple. If you look at even your automobile manufacturers, many of them have very highly depreciated asset. For example, Maruti Suzuki, if you look at huge depreciated asset. So what happens? Your cost of the asset will never come, you will not be huge in your expenditure part of it. So you will always, your cost of your end product will always be the little relatively lower compared to a new player in the market for whom depreciation is going to be large because of the cost out there. Normally what happens is asset when it is completely depreciated, there is always a scrap value which is there. So for example, I buy an asset for 1 lakh and then I estimate at the end of 5 years or 10 years the value, the scrap value is 10,000. That means I depreciate only 90,000. The value of its scrap value will continue to remain in the books as long as it is there till the day it gets out. Who owns it? Simple. Who owns it? You own it. There is a value for it, put that money, that is all. Yes, Pratishtha.
How do you deal with land and building in this case? Because
land, the value, original value at which you have bought, it just continues, that is all. Only you do what is called as revaluation, and that is once in a blue moon, that is not even touch about revaluation, we will worry about revaluation. Building normally depreciated, building has a life. Yes sir. There is depreciation for the building, land normally not. Building, yes, there is depreciation. No problem. Sir, again, don't hesitate to ask me questions. Relevant, irrelevant, I will tell you. I mean, if I cannot answer, I will certainly tell you. It's basically as per the tax laws, there are certain guidelines given. That is, otherwise what happens? You would want to claim the entire depreciation right in the first year, so that you will write it off as an expenditure. So government has mandated there are certain what is called as guideline. I'm not a guideline person, sir. That is why I changed my profession, I told you, right? So guideline, I think Pratik will share that. If you want, I can share a document, right? I can check a document. Pratik, just get the document. Yeah, I will. Basis on which is depending on the, for example, computers first year 60%. Why? Because technology changes very fast. If you look at cars, now it is 20%. Earlier it used to be 3 years. In 3 years you depreciate the car earlier. Then they made it because earlier they normally say 3 years. Now what happens with better technology, life of the car is extended, so they say 5 years out there. That is how the guideline basically goes. I'll come to you in a minute. One minute. There was a question here because
So if a machine has depreciated after 10 years and we still have life for 1 or 2 years and we are not accounting it.
No, I never said you are not accounting it. That is what I said. Normally you will have a scrap value, you keep that scrap value out there.
That will be minimal, right?
That will be very
but
minimal.
The potential to manufacture more products using it will not equate to what we have actually invested.
See, normally when you buy, the kind of estimate what you make will have to be more and more realistic. If at all you have a gain, it's a windfall gain for you. That's all. Normally it's more and more realistic. Or you sort of spend money to increase the life of that you capitalize it. See, that you have, for example, for what is called as your credit and loan purpose, the valuation is separate. Now when we talk about that is you look at a different valuation, you mortgage it, then the banker will assess what is the value and then he will give a loan. That is independent of it. Balance sheet, what we present to all the stakeholders is the value at which we have bought or the value at which market value, whichever is lower. Increase the value of what? Increase the value, rental value, but not the value of the building. The demand that operates on demand supply. Maybe value might have reduced of that, in the sense value of the building might have reduced. It will be ramshackle, right? But the demand to be there, if you have a place in Nariman Point, even if it's 100, 150 years old, there will be value out there, right? So value of the building, it might be ramshackle, it might be getting pulled down any minute, but demand, purely demand supply. Depreciation value, yeah.
Is it unique to each country, each government, or is there a universally accepted?
No, it's unique to the country, sir. It's unique to the country. Depreciation norms and the norms change from country to country, the way in which you treat many things. Supposing you go to Kazakhstan, where we were there looking at evaluating one of the entities, the way in which you treat many aspects itself is very, very different. That's completely different. So you got to first learn those because there is an accounting standard out there. That is why we are trying to move towards what is called as IFRS. IFRS is what is called as your universal accounting standards for across the world, but we have still not achieved that. Yeah, accounting concept, we look at what is called as what is the value at which you bought or sir, your balance sheet will reflect the same value, but what is the value that you will be able to sell it? Selling is different. Balance sheet projection, what I am presenting it to the public is different. See, don't mix both, that is independent. So that way, if I look at, I manufacture a particular good, whatever is the cost goes into it. What is the value? The value of it is whatever input that has gone into it. That is not the value at which you are going to sell. Value at which you are going to sell will be far higher. Don't mix both. Balance sheet is for information. Yes, sir. There are different kinds of lease, sir. There are what is called as wet lease, dry lease, financial lease, operating lease, etc. If it's a financial lease, yes, it comes in your books and then you will have to take care of it. So lease, there are multiple kinds, it varies with the kind of lease what you are taking. That lease part of it, we will cover it at I think almost towards the end of the course. The day it gets destroyed, you write it off immediately in your P&L as an abnormal loss, whatever is the amount of, for example, you bought a machinery at 10 lakhs. After 2 years when the value was 8 lakhs, the flood comes and completely washes away, no scrap value, gone. So what happens? It's at that particular year, it's an abnormal loss, value lost 8 lakhs, over. You write it off over a period of time, that we will worry about it at a later stage. Last 1 hour we have been talking, am I communicating? Are you following? That is more important, because at the end of 1 hour I wanted to check whether my pace is okay or you want me to change the pace, higher or lower, either way I can do it. Comfortable? You are following? Fine. At any stage you are not following, just tell me, I can change the pace of it, right? Because I have taught different audiences, I mean the freshies, the executive MBAs, in the country, outside the country, a couple of other places, etc. So, pace altering can be done, not a problem. I will come to you.
Going back to the examples will also get impacted.
See, what happens is your cost, how do you price it? Based on your expenditure, right? For a Maruti, depreciation is low, their overall expenditures might be relatively lower also. Whereas for a new car company, it might be far higher, right? So, then your pricing will also be higher. That is why it becomes difficult for you to compete on the price part of it. Understood, sir? Yes, sir. As long as you own it. The day you don't own it, it is not there. What you own will be there in the books. As long as the machine is in the plant, in your godown, outside your factory, wherever, as long as you own it. If irrespective of the place is not worried, I am not worried about the place. Who owns it is what I am worried about. Yeah, it will continue, that is all. A machine which is obsolete with a scrap value of 10,000, you are not able to dispose it, it is lying in a corner in your showroom. Yes, you own it, that is all. With you, sir? No. Yeah, ma'am.
The scrap value come down as well with time.
Yes and no. Sometimes the scrap value, basically what happens, it is a piece of metal, right? The price of, in fact, scrap value can increase also, because the price of metal can keep increasing. Right, but you don't record the increase, you record whatever is the value which is the lower of it. So, it can happen the other way also. Now that we have come to all this P&L, I said specific period, etc. Now, when I talk about the balance sheet, please understand this asset and liability position will change every day, agreed, every minute. So, when you talk about a balance sheet is always on a specified date, that is all. It is not for a specified time period, unlike a P&L, it is for a specified date, as of today. As of today, what is the part of it? That is all, as of today. So, when we say year-end financial statements are ready, that means P&L statement for the year April 1st, 2017 to 2018, 31st of March, I repeat, P&L statement from April 1st, 2017 to 31st of March 2018, agreed, plus balance sheet as of 31st of March 2018. Please understand, balance sheet, that is on that day, on the closure of that day, 5 p.m. of 31st of March 2018, whatever is the list of assets you own and whatever is the list of liabilities you own, that is all what you record, nothing else. Am I communicating? Balance sheet always on a particular date, it just lists, it is a simple list of what you own and what you owe. Now, when you prepare a balance sheet, sir, asset should be left side, liability should be right side, liability should be left, asset should be left, all kinds of things. What is what Pratik asked me day before yesterday when I was preparing for this class. Do not worry about it, left, right, whether up, down, etc. It is simple. Prepare a list of what you own, prepare a list of what you owe, that is all. Do not worry about the format as of now, because if you look at an American book, the format will be different. If you look at an Indian book, the format will be different. If you ask the accounting friends, the format will be even different. Now, sir, when is the order? When does the owner, when is the order complete? 1202, invoice is right, order complete, next day. You can place any number of orders, 11:58 you can place an order, 11:59 and 59 microseconds I can cancel the order. Possible. Algorithmic trading, right? Today people do all these kind of things, right? So, ownership transfer, order complete, that is all. Now, in those kind of things, Amazon, etc., Amazon or whatever your Flipkart and business, etc., the sale they record, but actual sale when happens, when does it happen? When the ownership transfer, when that fellow delivers. In transshipment, if the goods gets lost, please note the sale, they will have to rework and cancel that sale in the process, slightly different. When does the deal take place? When you basically strike the hammer out there, that is what is important. Please sir, mobile phones, your silent mode, alarm, I think switch off for an hour and a half, that is always better. Reason I insist is sometimes it distracts me and it distracts everybody because I teach with a lot of enthusiasm. So it can throw everybody out of gear. Now, yes sir, go ahead. Huh? Paid up hold it sir, hold it sir, hold it sir, hold it for 2 more classes sir, hold it for 2 more classes, don't worry. Because moment I get into paid up capital, everybody will get into trading and start asking me which stocks to buy and which stocks to sell, right, as of now. So you guys have to hold it for some time, not right away. Now, when I talk about we spend and then we buy it, what we say basically is what is called as, we call it as revenue expenditure or what is called as capital expenditure. That goes back to the question what she asked. See, she said, I have bought a machine for 1 lakh, then why is it not an expenditure? There is a slight difference, there is a revenue expenditure, there is a capital expenditure, that is expenditure which is capitalized. Expenditure which is capitalized will not go in the P and L, it will go directly to the balance sheet as a louder, as an asset, beautiful. Now that part is clear, I am very happy because more expenditure people should not say liability, right. Now it goes and sits basically as an asset out there, capital expenditure. Revenue expenditure, the day to day expenditure, that is pertaining to the particular period for which I am incurring, specified period, time period for which I am incurring. Supposing I say in this particular case, let me talk about, for example, April 2018, 1st of April to 31st of March 2019. Any expenditure pertaining to this specified period is what I will normally take it as, what we call it as we will take it about as a revenue expenditure, expenditure pertaining to the period. Now machinery I bought for 10 lakhs, life of the machinery is 10 years, now that is an asset. What pertains to this particular year, 1/10 of it pertains to this particular year, only that 1/10 of it is what is an expenditure, rest of it is an asset out there. That is the difference between revenue expenditure, normally capital out there. Anything which is pertaining to the, not entire marketing, entire operations, anything pertaining to the period. For example, I will say you have your I do not know who is the latest hero, you have a Hrithik Roshan to launch your any product out there and you pay 6 crores as ad fee, for example, for him to shoot for a 10-second video out there. Now that expenditure per se is part of your marketing and sales promotion, etc., but entire 6 crores is not pertaining to this particular year because you are going to use the benefit of that ad for the next 5 years or 3 years as long as he is still a star out there. So I am going to divide it that way. So all expenditures of promotion, whatever it is, etc., need not pertain only to that. Anything pertaining to that particular year is what you will record. No, no liability, no, expenditure is not a liability. Revenue expenditure, I pay my employees salary, then what happens? It is an expenditure in a, which is sitting in a P and L statement as an expenditure, P and L statement. The benefit of it you are going to derive for more than a year or more than a set time period. All the expenditure because of which you are going to derive benefit for more than the time period, say 1 year, is all capital expenditures out there, in short. Profit and loss statement, what goes is 1 lakh is the value at which you have bought, profit and loss statement is for the year 18-19, value of it is 10 years, what part of the machine I have utilized? I have utilized only 10%, that is what will go as an expenditure. Profit and loss account do not mix with cash outflow.
Sir, probably can we do it for a period of 10 years, then maybe all of these will get.
I will do it, ma'am, do it, you have to little more, yeah, sure, I will do it. Next, that's what I said, next class onwards he is going to be here and using an Excel and we are going to do that.
So assume we buy a building like this, all those other charges like the legal charges, registration, do I put it in
Landing cost, when you buy a car, you record as the value of the car as the ex factory price or the price of registration, your initial accessories that come in, and then what is called as your insurance, etc. Complete landing cost, all the cost which is incurred till it becomes operational in your hands. What we said now is what we call it as landing cost, that is cost at which the revoked asset is valued as an asset in your balance sheet. Right. Now, last aspect before I close the class today, in addition to this, there are only 4 terms that we need to know, especially in accounting. What we need to differentiate between is assets, liabilities, and then what is called as income and expenditure, income or revenue. Assets you procure, you do not pay taxes, no, everything, okay, you pay GST. When value of the asset is the value landing cost of my asset completely. If you are getting a tax credit because of that, that is a different issue. We are not even dealing with the tax credit, I am just looking at without that. We need to any expenditure, any transaction, let me use the word transaction, will always have 2 sides. We said, we took an example of what is called as bank loan. There is a cash, there is a liability. I make a sale, what is happening is goods going out, there is a cash coming in, or if not cash is not coming in, debtors is coming in, that is he is going to pay after some time. Any transaction you look at, there are 2 sides to it, and those 2 sides will have to fit into one of these 4, and beyond these 4 there is no accounting. Beyond these 4 there is no accounting. All you need to know is anything, whatever, any transaction will have 2 parts, first get that clear, minimum 2 parts, 2 to 3, minimum 2 parts, and that will have to fit into these 4. You will have to classify into these 4, that is all is accounting, nothing beyond that.